Hello, everybody. Welcome to our tax and legal update webinar for 2020. I appreciate everybody's time joining us on this webinar when everybody is enjoying ourselves at home. The focus of our webinar today will turn to tax and new developments in the tax and estate planning world. This webinar will highlight the key practical tax and legislative updates from the federal budget and elsewhere for you and your clients. These insights are going to offer you an opportunity to enhance your understanding of the connection between taxation, estate planning, and how insurance plays a pivotal role for business owners and high net worth individuals. Today we have Jos Herman joining us. We've had the opportunity to work with Jos for the past few years. She's joined us on a few of our roadshows as well, for anybody else who's familiar. She is a tax, estate, and financial planning professional who has held senior roles at an international accounting firm and Canada's largest insurer. At Resources and Solutions, Jos provides estate and insurance planning support and consultation on sophisticated cases in the high net worth and business markets. Additionally, she provides private business solutions and training focused on tax concepts, tax efficient investments, and insurance strategies, asset protection, and philanthropy. Also, Jos is an active member of the Canadian Association of Gift Planners, Conference of the Advanced Life Underwriters, Canadian Tax Foundation, and other organizations focused on helping Canadians with estate tax solutions. I know that we're all looking forward to hearing her speak. Without any further ado, Jos Herman.
Hello to everyone in Canada. Thank you for joining us today for a Q1 tax and legal update. It's an interesting time, but I think when we think about that opportunity to talk about tax, I get excited to do that. I get excited when we get to talk about estate and planning as we walk through this world of COVID-19. I'm going to flip through my slides here and start with this one. Tax is ever changing. I live and breathe it every single day. So I have my own consulting firm, as Gordon had mentioned, and I help clients, I help advisors, I help accountants that don't specialize in the tax and estate planning world. And my message always is, well, we're doing the planning as we know the tax rules now. And there's no guarantee that they will remain the same in the future, and they never do. And so the world is ever changing. And so when I think of that, I think that here's our best opportunity to stay informed and provide the best advice to our clients. So just keep that in mind when we go through our time together. Our outline. So we'll talk a little bit about the economic stimulus. We'll hurt your brain a little bit with respect to that. We did have some provincial budgets that did get pushed through before March, mid-March. We'll focus a little bit on the legal side from the executor standpoint, and then we'll round out our conversation when it comes to estate planning and how insurance weaves through each of those aspects, and especially on the estate planning side. In terms of questions, just because the platform that we're going to use today, we'll hold them off into the end, and I'll make mention that you can certainly connect with your SSQ wholesaler after our time. So when we think about the economic stimulus plan that was put forward by the federal government, we're talking billions of dollars. They first gave a range of about 82 billion in terms of support. And so when we think about that number, it's certainly going to rise. And they provided a stimulus package in terms of an individual basis and also from a business standpoint. So when we think about that, we're going to focus that and break that down into that individual and business support to give you some guidance for perhaps for yourselves, for your families, and your clients' families and their businesses. So when we think about filing due dates for our tax returns, as an individual, we had a normal due date that was coming up here, April 30th. You would have been compiling that yourself. We do have an extension that now pushes into June 1st of this year. So again, that filing date has now been extended. For any of you that are advisors as a self-employed individuals and or your clients, we did have a June 15th date. That still remains unchanged. So again, just a reminder in terms of those filing requirements. If I jump now to the world of trusts and corporations, where we get a little bit more complex in terms of filing due dates, it all depends from a trust standpoint. If you had a year end of December 31, Your normal due date would have been March 30th. That's now been pushed out to May 1st. If I had a trust due date filing of April or May, that has now been pushed to June 1. If we look then to the corporation side, normally I would have 6 months from my year end to make my filing for my corporate tax returns, that T2. And again, there's no filing extensions associated with those. So again, if I have a year end of December 31, etc., then that gets the same filing time frame. But they did make some change in terms of if my filing due date is after March 18th and or before June 1 of this year, you do have a slight extension that pushes you out to June 1 or your clients' corporations. Now, that just talks about the filing requirements. But what about the actual taxes due? So those, again, if I've got taxes payable from an individual or trust or corporate taxation in terms of Part 1 tax, those would not be payable until September 1 of this year. So again, there's a delay in terms of that cash flow for those individuals, trusts, and corporations. The other aspect of it then is that there's no assessment of any penalties or interest if that balance is due and paid by September 1 as well. So again, delay in terms of filing, delay in terms of requirements to actually pay the tax, and in terms of looking at the dates, just have a look at CRA's website just to confirm any of the timing that you're looking at for your particular entity or relationship. This is all a deferral. This is all a deferral. That cash will be due at whatever given time point, like if it's September 1. So again, if I think about any of the provincial side of it, where if they're saying property taxes are going to be deferred or utilities deferred, or any of the mortgage programs are out there, cash will still need to be, in hand to pay for some of these taxes that are due at some point in the future. So again, if you're at all in the financial planning world and you're looking at doing cash flow assessments and plans using Navaplan or, Razor, these may be adjusted in terms of timing and some of the planning that you're doing. So let's jump to the individuals. We're going to jump, like I said, in terms of looking at the program and the plan that on the federal government standpoint. Unfortunately, we don't have time today to go individually by province, but we'll look at the stimulus package in terms of an individual basis. And the biggest one that we have available right now is something called CERB, and it's Canada Energy Response Benefit. This is probably the one that we've heard most about. It did go through some modifications and name changes throughout, but this is where we sit at right now on an individual basis, looking to obtain money from the federal government side. The amount right now is $2,000 per month, with a total maximum taxable benefit, right? So this is taxable on your tax return of a total of $8,000, because the whole plan as it stands right now is for 4 months. The criteria, if we have a look at that, it's just asking questions of Canadians. Did you stop working because of COVID? Were you expected to be without employment this is very important, for 14 consecutive days in that initial 4-week period, right? So again, that criteria, they just simply ask questions, but eventually they will ask and confirm with you that you didn't have any other sources of employment or self-employment income. In terms of the eligibility, there is an income test associated with it. So they're saying, did you have income, i.e. salary, self-employment income, at least 2019 or the 12 months prior to your application? So again, they're looking to see, were you a taxpayer prior to this? And again, if you're any business owner that had received non-eligible dividends, that would be included as a source of income. How to apply? We have to now look at our online system and portals that CRA offers in terms of what's called My Account, and some of the portals through Service Canada. So again, you may not have applied through EI. This may be an opportunity through the CERB benefit plan to look to any benefit for your clients and or yourself, etc., during these times. Like I said, CERB and is the question I put here is yes, do you apply and would receive the benefits? It's for, again, were you self-employed? Yeah, you're likely to be able to apply for CERB. Were you a full-time employee for at least 4 months last year? And again, they've given the definition, did you work at least 30 hours or more per week? And the other question is, were you at least a part-time employee for at least 8 months? So there's different opportunities based on how your employment status looks like for either you or your clients to be able to apply for this CERB benefit plan. All right, that was on the individual side. Like I said, there's a whole host from a provincial side as well, if there's any other benefits. From the business side of it, there was also the focus on the economic stimulus plan in various areas. This is where we get a whole host of lovely acronyms, much like the CERB on the individual side. We're going to throw a whole bunch more at you in terms of the business side of things. So again, the federal government named a series of these measures for businesses in response to business disruptions. So again, we all know that during this time that you've got a whole host of disruptions. And so we'll look at different opportunities in terms of programs called CEBA, TWS, and CEWS. And again, like I said, provincially, you might have an opportunity somewhere else to receive some sort of funding as a business owner and or for your clients. So let's look at our first one, CEBA. Canada Emergency Business in terms of the amount. This is for corporations or not-for-profits, and it's basically a loan program, okay? So this is an amount that can be received by the corporation or NPO of up to $40,000. And how to apply is at your current financial institution, and then they submit that application to the Government of Canada. And essentially what they're saying is, well, you only apply at the one financial institution and or now they're the credit union in terms of receiving this loan. To qualify, you must have a 2019 payroll, though, of between $50,000 to $1 million in order to meet the requirements of receiving this loan. So if you look at the loan requirements, it is actually interest-free until the end of 2022. And if the loan is repaid by December of that year, 25% will be forgiven, up to a max of $10,000. And if the loan's not repaid by December 31 of that 2022, the remaining balance actually gets converted into a 3-year term loan at 5%. So the whole purpose of this idea of providing businesses, corporations with a loan is for basically those active businesses. So again, they're not looking at holding companies and doing this. They're looking at, did you pay out some salary and that for various amounts? And you'll have to provide a T4 summary, and they'll look at box 14. They'll look to see if you had that payroll account. And this is all done online. And so when you look at, would I qualify for this loan, or your clients looking at applying for this loan, so far we haven't seen any indication that dividends would count. This is strictly, did you pay out salary? And they will provide a loan and have some forgiveness in that in the next coming years. So again, loan program under CEBA. We now jump to our temporary wage subsidies. We've got 2 under this program. The first one we'll call the 10% wage subsidy. This was sort of the first one that got rolled out to Canadians and their businesses in terms of it equals 10% of the remuneration the employer paid during the 3-month period. So, and it's capped per employee, and there's only a certain amount that can be paid per employer. And this program is, again, based on the name of temporary wage subsidy, is only for a 3-month program that ends in June of this year. Again, the opportunity to have some subsidy back for the employer could benefit those business owners that have been paid out some salary. Here's where we sit in terms of the eligible employers. Those, again, corporations are a natural one. We've got individuals that can apply. Again, it's looking at those where you've got one or more eligible employees and you had a business or payroll account program on March 18th. So again, they're really laying in those rules in terms of trying to apply for the TWS. In terms of the business, it basically have to just reduce their remittances of income tax. You actually don't reduce the remittances of your CPP or EI premiums, but all you would do from in terms of claiming the subsidy is you would just hold back that amount, and then the CRA would then assess it from there. So it's really just trying to provide cash flow for these businesses from that standpoint under the TWS. So again, opportunity to apply and get 10% back for employers. All right. Our last final acronym. So we went through the first one under CEBA, we went through the next one at TWS. Now we have one under CEWS. So again, it's another wage subsidy, but we're going to call this one the 75% wage subsidy. This is the subsidy that went through the most questions, the most variations. This is the one that has given accountants a lot of headache, much like our times when we were trying to figure out TOSI. So again, this is where your clients, you yourself, may have to work with your accountants to see if you could qualify, etc., in terms of receiving this 75% wage subsidy. This is for corporations, etc., whereby they've suffered a drop in gross revenues of at least, and now they've changed it to 15% of drop in March of 2020, and then a 30% drop in the months of April and May. So that's our first requirement. Did you have a drop in revenue if I compared it to last year? And if they've also made some concessions to say, if I have an employer, a company that only started in last year, so I don't have any comparables, they will allow you to compare back to January and February of this year as a sort of an alternate way to compare. So again, it's a drop in gross revenue. How revenue is determined? Oh, they've given some lovely language in terms of, was it under your typical or normal accounting practices to determine that? The second part of that requirement and under this wage subsidy is, did you have a payroll account? And again, they're looking to say, did you have it at that given point in time? So two quite strict criteria in order to receive the wage subsidy under the 75% program. What this subsidy does then, it covers 75% of an employee's remuneration. And so the hope is that the government will, cover that 75%, and then you as the employer would then cover or top up for that remaining 25% of that remuneration. It also could apply for any new employees that happen to come on board for that particular entity, etc. So there is the reason why they're doing this, and kudos to the Independent Federation of Business, is that they said, hey, if we start to have everyone go on EI, businesses will start to have a disconnection between the employees that they let go. So this is an opportunity to, bring back those employees or still have those employees be paid during this time. So it's a good, again, way to connect back with employees. Here's our detail as much as we can given the time frame that we have. The maximum is $847 per week, and it's a greater of test. And there's also a greater of test if that person you are paying the remuneration of is a non-arm's length party. So again, working with your accountant or working with the client's accountant to determine eligibility is really important. It's a 12-week period in which we're looking at employers receiving this benefit up to June 6th, but there has been an openness if this pandemic continues to continue later than that. They have to pay the employees first and then they receive the subsidy. Employers will have to look at what's the baseline remuneration pre-COVID. So you basically have to look at what's the average weekly earnings from January to March. There is some leeway, or how do you determine if some employees are not paid weekly and they're only paid monthly? So this legislation only got passed here on the weekend, and so there's lots still more questions regarding it. So again, I encourage you to work with the tax professionals, and I know that your clients are too. And the way then to apply is through something called CRA My Business. This is again the online portal in which they're trying to facilitate everything online, and then potentially payments can then be direct deposited in a quicker fashion instead of CRA and you waiting for a check to be paid. So there's our cues. It's a mouthful. After all of this, I just provided everyone a link here. It has Q&A provided by the federal government. It has this breakdown between individuals and also on a business level standpoint to see if you qualify, your clients qualify, your family qualifies, etc. They try to do as best they can to provide different scenarios and different questions to say, does it apply to you? Whew. Okay. So I thank you for hanging in there. I thank you for being informed of the potential programs that are out there. We'll close off in terms of the last sort of announcements that were made to help Canadians in a couple of different areas in terms of, again, if you're any sort of investment advisor that deals with RSPs, etc., you all know that now we've got a reduction of the minimum withdrawals requirements under our RIF. And again, that's by 25%. So again, if I look at someone who's age 71, that minimum withdrawal would be 5.28%. And then that would be reduced by 25% in terms of the minimum that would be required to be taken out of that RIF. So again, if you're in the financial planning world, do you need to go back to a lower or minimum withdrawal? If you're doing cash flow, if you're doing financial planning, like I said, something to consider for your clients in terms of cash flow. The other point that I wanted to make in terms of announcements was the GST credit that they announced early on when all these announcements started. It's a one-time special payment under the goods and services tax credit. And it's looking at basically doubling the amount that would be paid. And this is the average numbers that they provided were, if you're a single individual, it would be about $400, and for couples, it would be $600. So again, they're trying to put some more cash into Canadians' hands. They're providing some more liquidity, and we'll use that word throughout our conversation today. I mentioned a couple of times about this lovely thing called CRA My Account, and you may say, what is that? My clients don't know what it is. I need the benefits, or they need the benefits. It's, like I said, a secure portal that lets you view your personal income tax information, and you can manage your tax affairs online. So the opportunity there is you can see your notice assessments. You can see what your contribution room is. It actually provides a whole host of information about your taxes. And again, you can set up direct deposits, etc. So again, this is where the government is pushing Canadians to say, if you're looking to get these benefits, you need to start registering for My Account. The other, I'll say, the good news story in all of this is that there's a uncashed check section of CRA My Account. And what the CRA said back in 2019, so a few months ago, they said, we have approximately $1 billion in checks that Canadians have not cashed. Wow. So as of May 2019, 5 million Canadians had an estimated $7.6 million of uncashed checks from CRA, and some of these date back to 1998. So if you are on my account and you're talking with your clients about this particular account portal, it is actually on the right hand side. I clicked it. I didn't have any uncashed checks, but again, maybe because people moved, different circumstances, they may have an uncashed check that they could still receive from CRA. So there's another good news story. Federal budget. When we initially were planning this webinar, we were going to talk about the federal budget. It was supposed to happen on March 31. As we all know, it's now been deferred. So this is normally where we see if tax rates have gone up, if we've got different programs in place, new credits, etc. So this is a wait and see, and stay tuned on that front. What we will focus on, though, is on the provincial budget side. So we'll try and focus just on some provinces that did have their budgets in the last early months of 2020. And so let's have a look at this. We're going to jump first to our friends in Manitoba. You had your budget on March 19, and that is a great day because I know I was born on that day. Yay. So in terms of Manitoba, they had, when we look at the personal tax rates, they had no changes in terms of the highest marginal tax rate, so that salary of 50.4. If I look across the country, most of the tax rates are sitting above 50%, the exception, like the Albertas of the world are still lower rates, etc. So again, wherever you are across this country, for the most part, we'll see what tax rates will look like as we move forward into next year, etc. The other thing I wanted to have anybody in the estate planning world know is that we all have in each individual province something called probate fees. Again, friends in Ontario, you would have something called estate administration tax, or EAT, and it's basically a tax at death for any assets that go inside the estate. And it has now been eliminated for a person's estate effective July 1 of this year. So again, I know that a lot of people think about estate planning. They say, I want to avoid probate tax. I don't want to pay this tax to the government. And so people look to do different probate planning opportunities, maybe like alter ego trusts or joint tenancy type of assets. So again, it's something from a Manitoba standpoint. Alberta has little to no probate tax. Quebec has a different scenario there in terms of, is it relevant when you're thinking about the need for liquidity and probate tax planning? The other thing I wanted to mention in terms of what's called professional corporations. Professional corporations are whereby accountants, lawyers, doctors, dentists, the folks that again provide services can incorporate across Canada. It depends on where you live, what the requirements are of who can be a shareholder in that particular corporation of that dentist or whatever. What is interesting from a Manitoba standpoint is the Optometry Act amended to allow optometrists to provide their professional services through a professional corporation. And again, if you think of the tax rate below $500,000, this is the reason why they would want to incorporate. I pay a low corporate tax rate, and then any money that I do need out of my corporation, I pay via salary or dividends. So I encourage you, again, as any insurance professional across this country, um, those professionals need insurance. If something happens to them, they do not sell widgets, they do not sell tables and chairs, they sell whatever is going on in their mind, the services, etc. So again, if something happens to them, that liquidity for insurance, DI, CI is critical when we think about their planning. Let's now jump to the corporate tax world in terms of 2020. We'll jump to just two couple of provinces that did make some changes recently. And again, we've got a drop in tax rates for Alberta in terms of the small business rate. We're at 11%. And anything above $500,000 is a very low 25%. So again, corporations that are there have a low tax rate, and they will continue to drop, as we'll see what happens over the next couple of years. Nova Scotia also had a drop in their tax rate in terms of any income below $500,000. So I'll encourage you to look to any of your provinces that you live in. Ontario, you just had an economic update from your side. And again, taxes, taxes, taxes. Look and see what tax rate your corporation is, your client's corporation's dealing with. And again, if there's any bump on the personal side of taxes. Which takes us to our BC budget that was earlier on in February, and whereby if we look at some of the changes that happened there, it really comes down to the personal tax side. They had a jump from the provincial side of 16.8 over to 20.5. So if you add the 20.5 on the provincial side to the federal rate, we are now at over 53.5% in terms of the highest marginal tax rate for tax. So that means like salary, right? So again, high rates when we look at people paying money out of their corporation or employees, etc. So when I think of any time that they make changes from a salary standpoint, what I've given you here is just a quick example of that salary number, that 53.5, has jumped from the previous tax rate of 49.8. And depending on your province, you may see the same number that happened, and or like we saw in Manitoba, it stayed the same. But what kind of gets sidled here in terms of what happens then to the capital gains rate? The capital gains rate is just half of the salary rate. So that's where we've got, we were sitting at 25% or 24.9%, and now it's jumped to 26.7. Why does that matter? Well, I'll show you a really quick example. Each Canadian is deemed to dispose of their shares of their corporation or any of these other assets they have for fair market value. So when I started to do these calculations over the years, I absolutely look at what's the capital gains rate for that particular province, etc. So here's a really quick example, and I really encourage you to, again, chat with your business owner clients in terms of what is their capital gains tax at death. So let's assume that your client has $5 million of value of their shares, and the capital gains tax calculation then says we will minus the ACB or the adjusted cost base of the shares, and that gives us a capital gain of basically about the same number. When I started doing these calculations, like I said, even before 2017, so this is just BC 23.9, that person at time of death would owe about $1.1 million of tax. Wait, and in terms of the client not passing away, well, the tax rate or capital gains tax rate got bumped up to 24.9. So that client's tax rate or tax owing at time of death now just jumped to 1.2 million. Now with the new tax rates, we've got 26.7, and the tax rate or tax owing is over 1.3 million. I really encourage you to do these simple calculations for your clients to talk about where does, them not passing away, them not choosing not to do any planning. Well, if tax rates go up, which again, they're guaranteed to do, that liquidity on death, where does it come from? Where does over $1 million come from to pay for the tax? Now you may say, or the accountant may say, well, you know what, there's this capital gains exemption. We could have a savings at tax either during our lifetime or at death. Absolutely. So in terms of our 2020 rates, in terms of claiming the individual capital gains exemption, again, this is the individual claiming it, we've got an increase of up to $883,000, or a little bit over. If you're in the farming world, you have an exemption of $1 million. So again, it is a tax savings, but I guarantee, and I put the caveat on here, does the client qualify? The first two requirements are, well, did they actually sell assets? So if I'm a business owner, I've got a corporation, and inside my corporation, someone just wants to buy my inventory, they want to buy the assets inside of the corporation, I don't get to claim the capital gains exemption. So again, what is your client selling? Are they selling their shares? Yes, the capital gains exemption could be claimed. And I use the word could because these shares have to meet the requirements of being qualified small business corporation shares. Really strict in terms of the criteria for the type of shares in order to claim the capital gains exemption. So again, we've got more exemption room, but the question is, will your clients qualify? I bring this whole conversation about tax liability. No matter what your tax rate is in your province, no matter what your capital gains rate is in your province, the question is, are you doing some sort of mini sort of tax calculation with your client and having the discussion of, is there liquidity there to fund this tax liability? Do we need a tax efficient liquidity mechanism or financial tool for your estate? Two great questions that you can certainly ask. Start the conversation if you haven't already done so. And again, if we have to then utilize the expertise of the accountants, the tax professionals in doing so, that's what I look at. And again, it's those big questions that we ask. This whole idea of liquidity at death, I think, is more poignant now when we think about, things like COVID-19. Is there liquidity now, potentially in the future? And I think about this, especially if trying to be an executor right now. So where I wanted to focus our attention in terms of the executor, think about this. If someone asks you to be executor, if your clients have chosen certain executors, there is requirements. So you think about then, they have to do a final tax return. And I say they would normally probably hire an accountant to do so. They would then receive like the notice of assessment or reassessment. Taxes, I guarantee, will be payable with any interest or penalties that would be due. And then the requirement of the executors to file a clearance certificate. And then they wait. And when I say wait, I've sort of mentioned this to you before, if you join me in any sort of learnings that we've had, is a clearance certificate. I go as an executor and I say, hi, CRA, I just want to get this clearance certificate to you or ask of you to say if there's any other taxes owing. And CRA then responds back with a clearance certificate. CRA's waiting time is somewhere between 6 months to almost 2 years. They are trying to aim to bring those targets down. So the question is there liquidity in that time frame and during this time frame to actually pay for taxes, etc.? So that's the first thing when we think about the duties of the executor. The reason why the clearance certificate is so important when we think about this for the executor, it confirms that all the taxes, interest, and penalties owed by the estate have been paid. It's a liability checklist. CRA is one of the biggest creditors, and as an executor, I want to make sure that that liability has been taken off my plate. So if I think about this clearance certificate, taxes owing at time of death, what does the Income Tax Act say? Well, the Income Tax Act says it requires an executor or that legal representative to obtain a final clearance certificate. It is saying, get that clearance certificate. It is required under the Income Tax Act. The second part of this is that it actually holds the executor personally liable for any taxes, interest, and penalties owing by the estate if he or she distributes any property, etc., prior to obtaining such certificate. Really key. So again, it pushes the liability away from the executor, but again, a requirement, especially under the Income Tax Act. Failure to obtain the clearance certificate exposes the executor to personal liability, especially if the estate has already been distributed. And you can do interim distributions as an executor, right? So again, beneficiaries will always knock on your door or your client's door to say, I need cash, etc. So what does happen is executors, and I gave you a little quick example here, is that executors can distribute, but then they can say, I'm going to hold back a certain amount for any taxes owing. So it's a common sort of practice because, again, they've got a lot of pressure from these beneficiaries to receive cash, property, etc. This is where we'll take our legal conversation to one of the cases here last year under the Muth case. So again, we laid the foundation for you. Executors need cash. They have a liability in terms of, again, paying taxes and interest and all those things like that. Beneficiaries are saying, I want cash on our side, distribute out of the estate. Well, this is an example under the Muth case that I wanted to share with you today. Let's give a background. So Mr. Muth passed away, and this is back in 2011 or prior to. And he was actually separated, divorced from Miss Muth. And at that time, the question is, well, who receives the estate? So they actually had to go through a mediated settlement between Miss Muth and the other respondents or the other beneficiaries, the nieces and nephews of Mr. Muth. At that time, it was decided that she would apply for probate of her ex-husband's estate. So now we have the foundation. Mr. Muth has passed away. We've got an executor now of Miss Muth, and she has beneficiaries, and the estate division is 55% to her and 45% to the nieces and nephews. All right. What happens? So as an executor, right, I laid out the foundation to say she's probably going to hire that accountant to then get the taxes filed. And so does. She hires an accountant and he advises her to hold back $25,000 for taxes owing, and she could potentially distribute the remaining balance to the estate in proportion to that 55%, 45% split. That's what she does. Unfortunately, and there's always an unfortunately, here's the issue. The holdback, that 25% that the accountant initially told her to be, held back, was shy of what was actually owed to CRA. It wasn't enough. So what Ms. Muth said was, okay, well, I'm going to seek reimbursement from these beneficiaries in terms of that proportionate share. What do you think the beneficiaries said to her? These aren't her children. These aren't any biological children, all those things like that. The beneficiaries said, you are out of luck. We got our money. I'm sorry that you didn't make these calculations correctly, etc. They go to court again. So the court found that the executor could not legally require beneficiaries to indemnify the executor for the payment of taxes owing for the estate. And here's the big thing. Her failure to obtain a final clearance certificate prior to distributing the property meant that she was personally liable for the taxes and related expenses. This is a story again of, we all know that not every estate goes smoothly. It takes time. There's court cases after court cases of, again, beneficiaries not getting along, etc. If this was a different scenario where we had beneficiaries liking each other and everything, they could have said, okay, I understand, we'll give you some money. But again, this was not a relationship, certainly, that these beneficiaries would help in terms of paying for some of the taxes owing. Liquidity, liquidity, liquidity. It's liquidity when it's most important. So again, if I think of those insurance opportunities to fund tax liabilities, etc., it does help. So again, this is your conversation. Start to have the little mini calculations of tax. Talk about liquidity. Where's the liquidity mechanisms when it comes to providing a guaranteed liquidity option for executors, estates, beneficiaries, etc. All right. So let's sort of round out our conversation in terms of where we know from the government side in terms of some benefits, where some cash flow is needed in terms of liquidity. We talked about the legal side for executors having, again, liquidity. From an estate planning standpoint, here's my commentary. It's crucial to continue planning for your client's financial future, especially in uncertain times. Planning does not stop. This is the time to talk about liquidity. This is the time to talk about cash flows. This is really the time to talk about diversification of our client scenarios. When I think of diversification, I think of a case that I was working on where they had just real estate and really no other assets. There was no liquidity in the estate. The assumption was we'll just sell some of the real estate. How easy it is for an executor, et cetera, to sell real estate right now. What market are you in across Canada? So again, your opportunity to talk about a liquidity mechanism. And what planning tools does the client have? Do they have their wills up to date, et cetera? So again, you have an opportunity. You really do during these times. If I think about what estate planning is, it may involve some complexity of putting in trusts, right? It definitely involves life insurance. Are beneficiary designations up to date? Do you still have someone that is passed away? Is there contingent beneficiaries? And again, are wills, powers of attorney in place at all, or do they need to be updated, etc.? That's estate planning. They're just tools along this circle of estate planning. I just wanted to give you a really quick update just on a couple of provinces when it comes to temporary measures, when it comes to implementing a will, executing a will. We'll focus first on Quebec. We'll jump to Ontario, just to kind of give you an idea that just recently, Quebec identified that services provided by notaries and lawyers are essential services. They have the choice of remaining open. So this has put a little challenge, not only for notaries in Quebec, but lawyers across Canada to say, how do we then make the execution of wills and witnesses possible? And what protocols do we have? I was chatting with a lawyer last week, and she said, we're passing documents across boardroom tables. We're passing them through doorways, etc. So I think of the steps that have to be taken, not only in Quebec, but elsewhere. And what the Quebec organization or province has said that as of April 1, notarized documents can be signed remotely. And again, that's under exceptional and temporary measure. In Ontario, so they announced on April 7th that they released an emergency order, which temporarily allows for the virtual execution of wills and powers of attorney by means of what they're defining as audiovisual communication technology. Oh, the Zooms of the world, what you're experiencing today. And so again, this idea of I can execute a will virtually, but they have put some stipulations or requirements in terms of one of the two witnesses must be an Ontario licensed lawyer or licensee. So again, I know that we've got situations where will planning still needs to be done or is in the process, etc. And the challenge when we think about these temporary measures then is the lawyers now have to have 2 to 3 video conferences simultaneously to meet the requirements. So again, if you're in a province that does allow holograph wills, whereby I write it in my own handwriting, that could be a temporary measure, at least for something you could do for your mom or whatever, or your clients to think about, to at least have something in place. So there's our sort of 2 temporary measures in those couple of provinces. Look to your own provinces in terms of what's happening on that front. But here lies the question. Will this lead to long-term permanent changes to adopt technology in the execution of estate planning documents? You ask the lawyers, they say, well, the real estate agents can do it. They can do DocuSigns, etc. Oh, think of the world, aside from what we're chatting about in terms of wills, etc. Think of the world of e-applications. This is facilitating your business right now. The SSQs of the world are allowing you to do business still. So again, I know I ask you to connect with any of the wholesalers or the team at SSQ to look to say I need training, or they've got some webinars associated with that, and they've got a whole host that either have happened or will happen in terms of your training. What is estate planning? If we round out this conversation, it's just about control, isn't it? It's the ability to control the disposition of property in accordance with your objectives, your client's objectives. That's how you frame it. If you think about this time of lack of control, that's probably what on people's minds. So the idea of control in terms of the estate planning side of your practice, that's what you can still offer in terms of wills need to be done, etc. From the life insurance side, life insurance is part of that estate planning. So as we sort of mentioned in that spectrum of wills, trusts, beneficiary designations, the beauty of a life insurance policy is twofold. It's choice and control. It's choice in owner, it's a choice in insured, who pays for it, and the choice of beneficiary designations. I do not need to go to the lawyer's office to make a change in my beneficiary designation. I'll say for the most part. Think of that choice. Think of that control that life insurance policy offers. That's what you need to be chatting with your clients about. Bring some control back into their estate planning. If we talk about the tax side of this all, so on death, as I mentioned with our client before and how we did that simple calculation in terms of tax liability, you are deemed to dispose of your assets at fair market value, and you'll pay income tax on the disposition. So any of the registered assets that we talked about, non-registered assets, everything from stocks, mutual funds, and to those clients that love real estate, taxes are due. We talked about when they're owing, the liability associated with the executor, etc. So here's just a really quick way to show your clients that idea of estate planning, etc. When it comes to the taxation side, all these assets, RSPs, the stocks, the real estate, and don't forget that corporation that business owner has. If we want to get that out to the beneficiaries, taxes are going to have to be paid. Forget about any rollover provision to spouses or whatever. Taxes are there, have to be paid. The life insurance death benefit proceeds can be part of that to bring the liquidity, the quick liquidity. I asked one of the wholesalers at SSQ, he said, well, how long would a claim be? And it's literally a couple of weeks potentially to get liquidity funds into an estate, into beneficiaries' hands. Life insurance, like I said, is part of that estate planning. A life insurance strategy is simple, effective, and again, it should be a part of that overall estate plan. Think about how you can be the person that brings the check. Think about how you can bring this risk management tool to your clients, especially during these times. The next steps, as we started our conversation today, the world of tax is ever changing. The world is ever changing, absolutely. Still assess your client's needs for insurance. I know that from the SSQ front, again, the medical requirements certainly have changed, and thank you to SSQ for doing that. You have the opportunity in terms of e-apps to still help your clients. And again, wherever you are across this great country, connect with the SSQ team. And again, you've got some great people to help you out there and the technology to make things happen. This is where I end my time with you. I really want to thank you. I want to thank the team at SSQ, all the folks there, and I wanted to provide a whole host of information to help your clients to have the discussion about liquidity, because it will continue to be had, and I want to hope that you have a healthy week as you go forward in your tax and estate planning worlds. So thank you very much for your time, everyone.